If the Strait of Hormuz stays closed for another 60 days, I think we get to all-time high oil and gas prices.
The time to facilitate higher oil production was 5 years ago.
It's a double feature this episode. We're tackling the energy crisis from the buy side and the sell side. Josh Young is an oil and gas investor who's long held a bullish view on crude and warns the situation is unraveling quickly. U.S. President Donald Trump's saying, "I think the war is very complete."
Shocking for the U.S. president to come out and just lie.
Then we've got Patrick O'Rourke, an oil and gas analyst in Canada, to talk about what this means for the Canadian producers and Canadian oil prices.
A very long day in the office. It's a volatile situation.
What is the catalyst for energy stocks to move higher? Are you investing like oil's going to 200? Did Iran change the value proposition of Canadian energy? When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. The content provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult with a qualified financial advisor or professional before making any investment decisions. Hey everyone, it's a brand new episode of In the Money with Amber Kanwar. Iran is still the key focus for the market, so it's the key focus for this show, especially as we've seen a number of developments this week. We had U.S. President Donald Trump try and say that the war was close to being over, but it was clear from further escalation that was not the case. You also had the International Energy Agency, which represents all the OECD countries, announced that they were going to be releasing 400 million barrels from their strategic reserves. That is a record amount. They have never done that. And of course, this agency was formed out of the 1973 energy crisis where there was a supply crunch coming from the Middle East. So in many ways, this is what they're supposed to be doing. But in other ways, it might not be enough to make up for the shortfall coming out of the Middle East. And then you've got Canada potentially looking for ways to increase energy production. It's been a long time since we've had a political leader in this country talk about increasing oil output. So put that all together. What does it mean if you're an energy investor on either side of the border? We've got a great double feature. We've got Josh Young, who is returning, an energy investor in the US, but plays a lot in the Canadian energy sector. And then I wanted to get sell-side perspective. And so I'm so grateful to our partners at ATB Cormark Capital Markets. They gave us Patrick O'Rourke, who is their oil and gas analyst, just to get a sense of what it's been like as an analyst covering the space, the kind of calls that you're fielding from all of the buy-side investors, and where conviction lies right now, again, in a very uncertain environment. And I asked both our guests, why haven't the energy stocks responded? What will it take for the energy stocks to respond? So it's a great conversation. And remember, we're still doing our swag giveaway. It's super easy. All you have to do is be a subscriber and comment wherever you're listening, and you can get this liquid assets mug and this market cap, which I love. And people ask me when I'm wearing the other hat out in public is, hey, where's the market cap? So it's in high demand. We pick a winner every single episode. Let's get into it. Josh Young, thank you so much for rejoining me on the podcast.
Thank you for having me. I really appreciate it.
We've been doing a lot of emergency sessions with some of our previous guests just because of what's going on in Iran and how fluid the situation seems to be. I don't know if you're bold enough to put out a prediction. Most everybody I read is not. It's a lot of equivocation, and a lot is coming at the oil market. So we're seeing these wild swings: $15, $20 per barrel, almost daily. And agencies, the International Energy Agency, for example, doing its best to offset a supply disruption. Before we get into some of the things that are flying at us, just at a high level, how has your worldview changed or not since last week when the attacks first started?
Yeah, I mean, I think it's a great question. I think it accelerates a lot of the problems that we were headed towards already. And if you want a prediction, if the Strait of Hormuz stays closed for another 60 days, I think we get to all-time high oil and gas prices, particularly WTI oil. And I think I have a hat for that behind me. So that can give you an idea
Like
of, I
with the
think, where
two
we get to.
handle, that's a bold call.
Yeah.
Now, let's stick with that. There are a lot of incentives, a lot of global incentives who don't want to see that happen. And the question is it enough that most people don't want to see that happen for that forecast not to come true?
I think it's a great question, and it's deeper than it sounds because people can affect it a number of different ways, and policymakers can affect the price a number of different ways. Ultimately, though, commodities settle on a physical basis monthly, and futures prices settle, and there are supply and demand, real physical factors that lead to real inventory levels. And when you run out of oil, you can't burn the paper barrels. And so, to some extent, it doesn't really matter what people want in the short term. It just matters what actually happens. And so, then back solving for that, this is where it gets a little more complicated. What concessions is the Trump administration willing to make? What concessions are other governments willing to make in order to avoid all time high prices? And that's where it really becomes a question of, hey, does the strait actually stay closed for the next couple of months, or does it open up a lot sooner?
What about the old adage that the cure for high oil prices is high oil prices? There's demand destruction at a certain point, and I imagine at $200 a barrel, that's the point.
Yeah, for sure. And I think we've already seen some demand destruction in certain refined products in places that already were unable to get enough oil to keep their refineries running at adequately high utilization rates. And so we saw jet fuel prices and heating oil and diesel prices in certain markets exceed $200 a barrel, which gets to that point where it's priced so high that it reduces consumption. So we've seen that level, and we have an idea that it's around that sort of $200, $250 a barrel level for these particular products, at least from a short-term price shock. What we haven't seen, though, is a settling out of the market where as some of these consumers of oil, the refineries, get more used to the current environment, you're going to see, I think, some of the supplies shift from countries, let's say like China, over to countries that have had trouble getting enough oil to keep their refineries running, like South Korea and Philippines. And so as you see the shift in those supplies, I think what you're going to see is a reduction in the extremely high margins on refining, because the refiners are responsive to margins and will do whatever it takes to get oil to meet that demand. And you'll see a shift over into much higher prices for crude oil. So yeah, you'll see demand destruction to some extent, but we've been in a supply destruction price environment for a very long time. And I get pushed back on this, but the supply destruction pricing has resulted in very low corporate profits across many of the incremental oil suppliers, the US shale companies that keep going bankrupt, various other companies around the world. And so now that we're shifting from that supply destruction environment for essentially almost a decade over to a demand destruction price environment, we won't see the full impact of that demand destruction until, let's say, many months or years of much higher prices.
Okay, and we're going to talk about what the investment implications of that is. But before we do that, uh, you know, seeing that that's kind of the direction you're facing, um, I'd love to get your perspective on how that applies to some of the things that people are doing, organizations are doing to offset this crisis. I mean, one is kind of jawboning. U.S. President Donald Trump saying, "I think the war is very complete, pretty much, with the U.S. very far ahead of schedule." That was a couple of days ago. That seems divorced from reality, but it did have an effect on moving crude. It was temporary. Um, is jawboning going to be effective?
I think trust, once it's eroded, takes a long time to rebuild. And it's sort of shocking for the US president to come out and just lie blatantly like that about something that's very important for the US economy and the US's position um, from a global sort of power perspective. And so we'll see. I think we'll see in terms of um, if people believe it next time. My expectation would be that they would believe it a lot less than they did that first time. But to be fair, it seems like there was a little bit of almost a mini speculative bubble where prices didn't move enough for the first week of the conflict. And then over the weekend, there were some additional videos that came out and additional strikes that happened on Iran. And then Iran struck various international infrastructure and tankers. And so that led to a huge price movement over essentially one trading day. And so that shift in prices really negatively, really, I think, was susceptible to that negative price movement just from jawboning. So we'll see. But I think there was unusual price movements in both directions. And so again, maybe that made it more susceptible. But lying about stuff really is destructive. And I think it would have been helpful for him to have made a more moderate statement that would have preserved his reputation and preserved believability for a longer period.
I mean, you're sitting in Texas, so very kind of red-dominated state. Um, there are those who would argue that those kind of mistruths or outright lies have been commonplace out of the administration. But leaving that aside, I'm curious, just based on where you're sat, um, do you think that the Republicans, Trump in particular, pays for this at midterms?
You know, I think we'll see what happens at midterms. Obviously, these sorts of things are very dynamic, and to the extent, let's say, that the Strait of Hormuz is blocked for 60 days, which seems like a potential trajectory, considering that there's reports of some mines in place, but also significant military resources continuing to come into the area and additional allies bringing resources. I think there were reports that France was starting to send equipment too. Um, so let's say that it takes 60 days and then it's unblocked, and then we see an unwind of some of the most extreme negatives from the war, but there are substantial positives from a perceived sort of longer term peace from success. Again, this is a scenario. In that scenario, it's possible that that the Republicans might actually win quite a bit in the midterm. So I think there's a lot that remains to be seen. Also, we haven't seen, so we've seen the jawboning and we've seen Besant talk about shorting oil futures and then come out a few hours later and deny it, which is a very interesting. You sort of can't take back something like that once you say it. But I think it remains to be seen what else is done. Maybe they send out stimulus payments. Maybe they send out some other things. Maybe they lower gas taxes to lower the impact on the consumer. I know the taxes in Canada are even higher than here in the U.S., so maybe they'll do that in Canada and other countries too. I wouldn't hold my breath, but it is in the government's control in many of these places how much the consumers are hurt. And so we'll see in terms of what the election impact is.
One of the things that we got this week is from the International Energy Agency confirming that they are going to be releasing 400 million barrels from strategic petroleum reserves. There's still questions on the timeline, which countries, who participates, but it's the OECD countries that have kind of come to this unanimous agreement. And 400 million barrels sounds like a lot, except what is consumption? I think it's 45 million barrels per day. So this is a very short-term solution. What happens after that?
Well, I think the SPRs were built for this. So I think they should have released them day one of the war, or at least started the process towards that. There is a stock versus flow issue, which is that it will take some time for the oil to be fully released, so it doesn't fully offset the impact of the Strait of Hormuz being mostly blocked. But it I think the simplest way to explain it is some positive action is much better than no positive action. And then, what will be done, let's say 60 days from now, I think is a question that we'll have better answers to, let's say 30 days from now. I think there's various policy possibilities, and one of them that could be quite negative to consumers and, like you were referencing, to voters would be some sort of forced reductions in consumption by governments, similar to what we saw during COVID or what we saw in the 1970s with gas lines and other sorts of forced reductions. We're already seeing that, by the way, to a limited extent in the Philippines, which is why I mentioned them, and elsewhere, where you're seeing a push towards 4-day work weeks and carpooling and other steps like that. So I think
They
we'll see
start
some
rationing.
moves. Sorry, what's that?
They start rationing the supply.
Exactly.
Okay, so as we've discussed, there's a wide range of outcomes, right? And in a worst case, where the Strait of Hormuz remains closed, oil maybe goes to $200 per barrel. If things get resolved, call it over that time, does oil go right back down to where it was? Or does there remain a premium? How long does that stick around? I mean, I feel like the market has kind of a short memory. They quickly price in geopolitical risk after the fact and then forget about it when it's no longer a going concern.
Yeah, so I look at what happened in the 1970s as a sort of way of filtering this, because there were two energy supply shocks in that one decade, and we got to see what happened during them and what happened afterwards. And in many ways, there are actually really interesting parallels between what happened then and what happened in 2022 with Russia's war on Ukraine and the price spike then, and then the pullback in price. And similarly, the reset in energy equity prices much higher from 2020 to the middle of 2022. And similar, the reset in energy prices, let's say from energy stock prices of 1971 to 73. So my expectation is the combination of actually a tighter market than the bandwagon was sort of indicating, the IEA, EIA, various investment banks and ostensible experts and so on. They all said there was going to be a super glut, and that hasn't manifested, again, looking backward at the data prior to this war. And that's very similar to the 1970s. So I think you end up with a reset higher in oil sort of regardless. And then there's a further reset higher, like you're alluding to, potentially from some additional risk of disruption, depending on how this war is resolved, along with maybe some additional premium from the restocking of these strategic petroleum reserves over some extended period of time.
I think a big question too that investors are asking is, why aren't I seeing any of this priced into energy stocks? And why aren't they reacting? And why aren't they moving? And what's your answer to that? And what is the catalyst for energy stocks to move higher if there is going to be this kind of premium in their underlying crude?
Yeah, I think one, energy stocks did quite well ahead of this. So if we look over the last 6 months, a number of the energy stock indexes are up 20%, in some cases 50%, depending on sort of which index. And some of the individual stocks are up 100% since the April or May lows of last year. So, and even some are up even higher than that, but many of these stocks are up quite a bit from those little levels. So some of this may arguably have been priced in. And then I think there's a lot of uncertainty around the severity. Again, when you have the US president come out and say, hey, this is mostly done, and various other statements like that, I think people take that into account in terms of their purchases or sales of energy equities. And then I think it's just a matter of time where, as we see prices continue to rise in a more stable manner than we saw on Sunday night, where they went from 80 to 120 and then back to essentially 80 over a 36-hour period. So as we see a more stable move up, and then as we see an increase in the back end of the curve, so the futures prices for oil 3 months from now, 6 months from now, et cetera, I think we may see that expected move in energy equities up, just with some minor delay.
we're going to talk about this. You've got your pro picks as usual, but at a high level, how are you expressing this in the portfolio? Are you investing like oil's going to 200, or is that just something you see play out? But, are you putting your money where your mouth is?
Yeah, it's a great question. So I'm a portfolio manager for a fund that I'm one of the largest investors in personally. And so that's led to material outperformance. Again, past performance may not be indicative, but what that means is that I try to navigate things very carefully. And so what I've been doing is a combination of selling stocks that, in my view, don't have a lot of upside price convexity anymore after they've moved. One of the companies I'm invested in, one of their oil fields is getting bought. The shares are up a lot already. There's deal risk there. The deal is sort of already priced in. And so it makes sense to me to sell some of that stock, for example, because there's limited upside, but there's a lot of potential downside. And to hold some cash while also with a smaller amount of money going and buying some equities and related securities that have asymmetric upside that could go up 5x or 10x if I'm right about these sort of price predictions.
And from an industry perspective, is it in certain areas within energy, producers versus refiners versus oil field services? Like, how are you thinking about where those 5x opportunities are?
Yeah, so coming into this, I was extremely bullish on oil field services, and I still own a lot of drilling rig stocks and certain other similar companies. And I think we're going to talk about one of those later.
Mhm.
But I actually think the biggest beneficiaries of this are going to be the producers. I think the market sort of incorrectly interpreted that this is going to be super bullish for refining. But when I look at the amount of refining capacity coming off versus the amount of crude oil capacity coming off, and now we're starting to see announcements of refinery expansions, and President Trump announced yesterday a brand new refinery, which will be the first new refinery in 40 or 50 years here in the US. And so I think refining generally may be less of a beneficiary than people expect. I think the pipelines may not be nearly the beneficiaries that people expect. And so I'm most interested in some of these small cap companies where a small move in oil price up has a dramatic move impact on their intrinsic value. And for those same companies, a large move up in oil prices could send them up a lot more. And I guess I became somewhat famous for some of these similar sorts of picks in 2021, where in one case I talked about a stock on BNN and it went up 25x and then it went to zero. And so, hopefully I can avoid the zeros, and hopefully I'll sell a lot of these things if they get anywhere close to up 10x or 20x. But there's always risk in these sorts of more sort of speculative names. And I think it makes sense just to face that and be honest about it.
I know, and we're going to review that with one of your last picks. Because you're right. You're definitely playing in the riskier area of oil and gas. As you're not, I don't think you own Canadian Natural Resources or Exxon, but that's not your style when it comes to investing in energy. Last question before we get into those pro picks is, where does Canada rank? You are a U.S. investor. You've got plenty of opportunity in the U.S. You could go abroad. I know from time to time you do have Canadian energy stocks. Did Iran change the value proposition of Canadian energy?
Yeah, I think it made me a little more favorable to Canadian oil and gas stocks. I don't view the current government in Canada as particularly favorable to the oil and gas industry, unfortunately. But I do see events being favorable for that industry, and the Carney administration at least is a little less hostile to the oil and gas industry than Trudeau was. And so I already had a lot of exposure in Canada, and I've been adding exposure to Canadian oil and gas producers and services companies in the last week.
Okay, well, let's see where we can find those opportunities and get into your pro picks. ProPicks is brought to you by ATB Financial. With over $100 billion in assets, ATB Financial is powering possibilities for more than 843,000 financial services clients. ATB Cormark Capital Markets is a leading North American investment firm providing holistic corporate and capital markets advice and full-service financial solutions. Visit atb.com/inthemoney for more information. Okay, Josh, the last time you were on was June 3rd last year. You pitched Journey Energy, Ensign Energy, and Vital Energy. Journey and Ensign, you're coming back. You're saying stick with it. Journey has done incredibly. It's basically doubled since you chose it, and since done well, up 17%. Vital, flat. It's up about 4% over that time. Your average return since you were last on is about 40%. Since we're going to talk about Journey and Ensign, just a quick word on Vital Energy. Do you still hold it? Did it perform as expected? Do you have to wait a little bit longer?
So my third pick actually is sort of tied to Vital. Vital got bought, and I didn't like the deal at all. I thought the buyer stole it. And I was so inspired by their effective stealing of it that I decided to go buy in size the acquirer. I dramatically increased my position of the acquirer. And so I still net effectively own the Vital assets through a larger entity of a company that's almost like Strathcona of the US. And so, yeah, Vital was very disappointing. And frankly, I think the management and board there really let their shareholders down. They got paid a huge amount of money in their sale, and they did what looks like a terrible job based on their proxy filings of what their sale process looked like. And I was chairman of the board of a Canadian E&P, and we dealt with a hostile bid and navigated it to a better price. And in my personal experience, as well as observing a number of these different processes, this was very disappointing, and it was a pretty big mistake.
So you're right. Vital was sold to Crescent Energy, which is the one of the pro picks that you've come to talk about. And for those who don't know, Josh can be very harsh about some of his pro picks that makes you wonder, like, do you actually like this company? What does it mean to be the Strathcona of the U.S. when you're talking about Crescent Energy?
Yeah, so I wrote about this for this newsletter that I launched actually since the last time we spoke. Sort of a fun side project that's ballooned a little, where I share a stock idea a month approximately, and then some oil and gas macro analysis. And the way I framed it is as a Moneyball type company where they go and buy some of the dented and damaged items available via companies and via assets, clean them up, and then when they're able to go and resell them for a huge premium. And so if that sounds similar to Strathcona, I think it's a very, very similar strategy, and Crescent just trades at a large discount. I think they've intentionally not really promoted the stock. I think they might be about to change that. But you have billionaires involved similarly, and a very successful trajectory. And it actually reminds me a lot of what Strathcona looked like about a year and a half ago, where after some initial success, the stock had traded off quite a bit, and was a really excellent entry point.
Do you own Strathcona?
I actually don't, partly just because of valuation. I think the risk on being a value investor is that you can't get too rose-colored lenses ish. You can't be too optimistic about things that you bought because they were very cheap. And
Mm.
so I think I did own Strathcona. I think there were periods where it was deeply undervalued, and I just it was deeply undervalued because of relatively lower asset quality versus similar companies. And when it traded up closer to that asset value of other companies, I shifted exposure to companies like Crescent, as well as to other Canadian companies that I think either have superior asset quality or have a much larger discount to intrinsic value.
Because you know the Vital Energy assets so well, Crescent has said that they can extract between like 90 to $100 million in synergies like right away. Does that seem achievable, overly ambitious, conservative? Do you have faith that they can clean up that business?
Yeah, so they've actually, subsequent to that initial claim, they've now doubled that. They said they already achieved the first thing, and then they doubled it. Again, this is very similar to the tremendous success that Strathcona's had with buying some of these unloved assets, maybe a little mismanaged, and turning them around quite a bit. I actually got to meet the head of asset exploitation and development for Crescent at a conference shortly before publishing the idea for my Bison Insights newsletter. And I mean, just everything you'd want to hear from the mid-level guy doing exactly the thing that's most important there, because you can see the metrics at a high level, and then you can also see the data on individual wells. But at a multi-billion-dollar company size level, both of those aren't telling you the whole picture. You really want to know what's going into the changes and then how realistic those changes are and what sort of the operating philosophy is and the work ethic and the engineering approaches. And I mean, truly, truly inspiring. Like, honestly, I don't meet many mid-level EMP executives where it's like, hey, I'd back you. But these guys, they've staffed it well. And because of their association, they're very closely associated with KKR. It's one of the negatives people have is that KKR takes a small management fee off of it. Sort of similar to how Strathcona had all these incentive units that the management team got. And one of the real benefits, I think, is that they've been able to staff their team with just excellent people, in many cases, very similar to the people that KKR employs internally. And so just very impressive. And I think they'll achieve enormous synergies. And I think they really understated it to be able to get their deal done. And I think they'll be able to even exceed this restated higher set of synergies.
Your second idea is you said you were loving oil field services, and your second one is Ensign Energy, which again was a top idea last year, and it's done well. I said you don't own CNQ, but this one, the chair is Murray Edwards, of course, of CNQ, and it has been under pressure since since the Iran attacks, and I imagine part of that is it did run up. But part of that might be the fact that it does operate in the Middle East. And so with all of those rigs in the production basically non-existent right now, is that why it's been under pressure?
Yeah, absolutely. I think that really hurt them. And actually, they lost one or two rigs. They lost the contracts for them in Kuwait ahead of this. And
Hmm.
so weirdly, I think the stock was down because they reported that they lost a couple rigs in Kuwait. And then there's this news, and I think they're being sort of doubly punished by the market for something which already happened, which was a reduced level of activity in the Middle East. They do have operations in Oman, which actually should not be too affected other than sort of the immediate physical risk of potential missiles or drones. And so I think they're being unduly punished, and at the same time, they're in a couple of spots like California and Venezuela where they have really substantial political tailwinds. These are both very surprising places that I think people were quite negative on when we spoke about it, as well as when I wrote about it for the newsletter. And it's pretty remarkable seeing how powerful those tailwinds are. There were just two I forget what they're called exactly, but essentially agreements for Shell and Chevron to farm in on PDVSA assets in Venezuela, and they're going to need more rigs. And Ensign, as of right now, is the only company operating drilling rigs, per their reports, in Venezuela. So I think they have a lot of upside there. And then California also, it's a very weird story, but
Hmm.
the governor there and the political party in power in California has really suppressed oil and gas activity. They've actually pushed some refineries out of business there because of very high environmental regulatory requirements and taxes and so on. And in a sort of cynical but sort of brilliant, cunning move, Newsom has started, the governor of California has started to allow additional drilling permits in California for the first time in many years. And this has sent the drilling rig count up there. And Ensign is the leading provider of drilling rigs in California. So, very sort of odd drivers of success for them. And I think the market's unduly punishing them for their Middle East exposure and insufficiently rewarding them for their exposure to these very hard to operate places where, through some degree of luck and some degree of perseverance, they're the leading rig providers in both those markets.
So it's interesting, yeah, because I'm reviewing what people say about the stock, and they just reported results, and they were punished because profit was slightly lower than expected. Their revenue, particularly in the U.S., was lower than expected, and there is this focus on Venezuela. How many rigs? I think they have like two rigs there. What is the stability of that given the situation in Venezuela as well as the Middle East? I mean, are you do the misses in the quarter highlight that investors are rightly focused on some of those other issues versus California? Like if California mattered that much, they'd be better able to deliver operationally.
Well, California is still ramping right now, and I think that they'll end up with many more rigs. Their guidance I thought was quite muted. They're very conservative, as you'd expect for a company that's controlled by Murray Edwards, and where he's the largest shareholder and I think chairman. And so I think they sort of sandbagged California, they sandbagged Venezuela, and they had the biggest impact that was negative for them that I think people didn't expect was these rigs coming off in Kuwait, at least from a forward guidance perspective. And then the rig market in the US has been quite difficult, and they've maintained market share, but the rig count has fallen quite a bit since we last spoke about Ensign. And so I think it's impressive that they've been generating more than $100 million a year of free cash flow, despite being in a market where utilization has been down and rig rates have been down, essentially margins have been down. And so I think that the market's wrong on this. I think that their performance is spectacular, and that the combination of likely, in my view, higher rig counts in California and Venezuela over the next year, in addition to what looks increasingly likely to be a recovery in the drilling rig market in the US and in Canada, as we see prices rise and potentially rise a lot more due to the situation in the Middle East. I see there being tremendous upside here. And the biggest single thing that people avoid with Ensign is the 900 million or so of debt that they have outstanding. And they paid off a lot of the debt that they had a few years ago. And I think people just haven't refreshed their view to incorporate the much lower level of financial leverage. But
Yeah.
that leverage offers them a lot of upside to the extent that I'm right and they achieve some of the operating gains and the rig count gains that I expect. I think there's sort of this asymmetric upside for them, both due to the financial leverage and due to the fundamental improvements for the business.
Can you hold the two views that, like, what if the strait is closed for 60 days and oil goes to 200 at the same time that you are bullish on an operator there, right? Because I imagine a closure of that length is quite negative for
Y-
Ensign.
Yeah, I just don't expect those rigs to get active again in Kuwait for some time. So, it's
It's not
obviously
part of
not up to me. I don't control it, but it looks like rigs are getting laid down across the Middle East rather than being put to work. And so, when I look at the potential upside to Ensign's shorter term financial situation, I see these agreements by Shell and Chevron, which likely are going to call for more rigs. And Ensign to me seems like an obvious winner of those rig contracts, which should be extremely lucrative. And then similarly in California, where they've sort of sandbagged and they guided to 8 rigs running in California, which is where they've been at very recently, but up a lot from 4 or 5 rigs this time last year. And so I see them running substantially more rigs there. But even if they don't, generating over 100 million a year of free cash flow at the bottom of the cycle as a drilling rig provider with a market cap in Canadian dollars of around $600 million is, I mean, it's phenomenal. They're generating a lot of free cash flow relative to the size of the company. And so, yeah, they have debt, but they can choose at some point to stop paying off. And now that they've refinanced their debt, they don't have to pay off any more of this debt. And in theory, they could go buy back 15 or 20% of their stock or pay a super high dividend. And that would be sustainable based on free cash flow at the bottom of the cycle.
Your third idea is Joy Energy. And I guess maybe it was a little bit more exciting when you brought it to us in June because it was down more than 70% over the last year. You had almost nothing positive to say about it. You didn't like management. I don't know. I think you danced around whether there was some fraud going on. Am I remembering that correctly? Um, and then it turned around and we featured it on our holiday special. It was just this absolute comeback kid. It doubled. Take us into the turnaround at Joy Energy. It is small, small, small. It's like $200, $300 million market cap. What ended up breaking your way for Joy?
Yeah, I mean, I think the choice to highlight it last year was that the stock was just too cheap and that I saw positive tailwinds from an operating and financial perspective. And those tailwinds have continued. And so I actually think it's more exciting here than it was there. There were financial irregularities, which I highlighted, and those have actually they've cleaned up quite a bit. And to their credit, I'll point out that there were a lot of negatives in their financial results and in their operating results, and through a combination of divestitures as well as apparent increased focus on these problems. I don't know how much credit I can take for highlighting the problems, but fortunately, they've been apparently working on them to resolve them. There have been improvements on their operations. There have been improvements in their financials and in their financial reporting. And so, I never said they were a fraud. I just said that there were these irregularities, and it's good when you see a company go from having irregularities to not having irregularities. I think it's indicative of there maybe having been some problems with their reporting, but not the sort of deeper problems like you're referencing. And so here. I think they're extremely, extremely well set up. The Duvernay play that they're in as a non-op joint venture partner with Spartan Delta is outperforming even my high expectations. And per Spartan Delta's public statements and presentations and so on, they see a path for well productivity to continue to improve on a multi-year basis. And it does seem somewhat likely that Journey would receive buyout offers either by Spartan Delta or by Baytex, which is adjacent, and has has had good recent results, but historically had struggled in this play, or potentially by a financial or private non-op type buyer that could be really interested in this asset. Just the Duvernay asset, even at lower oil prices, at sort of, let's say, $65 WTI, could end up being worth well in excess of the current share price. And in addition to that, they have almost 10,000 barrels a day of low decline oil and gas production in these very interesting water flooded conventional pools. And they have two power projects that have taken forever. They've taken a lot longer. They've cost a lot more than they should have. And in theory, both of those should come on this year. So as we're talking next year at this time, let's say, I would expect both of those power projects, even with all the delays and cost overruns, to be on. And so the combination of rapid growth at way higher returns than anyone, including me, expected in the Duvernay, along with the two power projects going from taking a lot of capital to providing what looks like a lot of cash flow into a scenario where there's not enough power generation across North America for the rapid growth of data centers and other demand centers. I think it's set up really nicely, and I could see even there being a bidding war like we experienced in the Iron Bridge scenario that could send the stock way higher than where it is right now.
What kind of premium would you expect?
Well, I think there's a benefit here to the CEO owning a lot of the stock, and the chairman bought a lot of stock, which was a great sign. It's really reassuring, especially when you identify problems and they sort of acknowledge the problems and start working on them, and then they go and buy a bunch of stock. It's very, very promising. So I think that insider buying activity increases the likely premium that's necessary. And then also the tremendous performance by Spartan Delta, their stock price performance, their operating performance, ironically may mean that it may cost them more if they choose to actually go buy Journey. Maybe not on a share for share basis more, but on a sort of total price tag more. I could see this thing getting bought for somewhere in between $7 and $10 a share, even before the recent oil price move due to the Middle East situation.
Josh, it has been a pleasure. Thank you so much for joining us on the podcast on a very fluid situation, but bringing us those ideas. We appreciate it.
Thank you.
Okay, so normally we end the show at Pro Picks, but you heard Josh. He's looking at a lot of Canadian producers, and we're going to shine a spotlight on the Canadian sector. We've got Patrick O'Rourke, who's with ATB Cormark Capital Markets. Of course, they're one of our sponsors, but I've known Patrick for a really long time, and he's on the sell side. And I thought it was a great opportunity to talk to somebody whose job it is to talk to investors, find out what the mood has been like. Why haven't the Canadian stocks been responding? What will it take for Canadian stocks to respond? And what does this mean for Canada's energy sector in general? Let's get into it.
Patrick O'Rourke, thank you so much for joining me on the podcast.
Thanks for having me.
I am so excited to speak with you. I've known you for a number of years. We typically only interview buy side, so you have the rare honor of being the first and I think the only sell side analyst so far that we've had. But you cover Canadian oil and gas, and I kind of wanted to get a sell side perspective on just what has your week been like? What have the conversations you've been having really since March 2nd, since the attacks on Iran began, and we started to see what looks like pretty unprecedented supply disruption?
Yeah, it's been a very busy sort of week and a half here. To give you perspective, and being the sell side, we had to be prepared pre-market for our morning call on Monday morning, which meant a very long day in the office on Sunday, making sure we had all of our ducks in a row on what was going on. We published a pretty comprehensive report that came out Monday morning, and I would say, at that time and still today, one of our key takeaways was that it's a very dynamic situation. It's a volatile situation. A lot of the original takes and probably even the conclusions that we're coming to today are still very speculative in terms of what this looks like, both in the short term and the long term. And so we're digesting information almost on a minute to minute basis. In fact, just before I came into the studio here, there was a formal release by the IEA that they've sort of formalized this 400 million barrel SPR release that's going to come out. News was sort of circulating yesterday on that, but then you see sort of becomes more official here. A few bucks comes out of the price of crude. What we've observed in the crude markets is that the volatility, and I think this is probably no surprise. I think a few have talked about it, but the volatility is primarily at the front end of the curve. Prompt contracts traded up to as high as $120. I think right now at this minute we're at 84. When we look at it and we think about these businesses, we're thinking about them in a much longer time frame. And 2027, the crude curve has probably only come up about $5-6. Now that is still positive for our producers, or the producers that we cover here. But we're trying to ultimately come to conclusions about what this means for the long-term outlook for Canadian oil and gas, for the profitability here. Even in the background beyond that, we have what's going on with Venezuela that we've been trying to digest. So, one of the most engaging things about being on the sell side and covering this specific sector is the fact that on any given day, you have a lot of news flow in terms of macroeconomics, what's going on with the commodity, the economy, et cetera. And then you cover a sector where it's not easy to operate an oil and gas company. You have reservoir risk, you have infrastructure risk. We see some of that even, we put out a report last night to our investors that there were some challenges with source gas for some of the oil sands operations. So it's been a very, very busy time that we've gone through here. But to be frank, I feel like there are very few times when we're not busy covering this sector.
Absolutely. And you mentioned Venezuela. I mean, that's how we kind of walked into the year, was all of a sudden regime change and potentially massive supply, which didn't really seem to stick in the markets in terms of price action. Iran is sticking in the markets, at least in terms of crude that needs to be delivered in the next month or two. But as you pointed out, investors are reticent to price this in for crude that they might get in the summer or the fall. That seems like a de facto bet that at some point this will be resolved and prices will come back down. And you kind of see it in the energy stocks as well. And I'm curious what color you can add to the fact that Canadian oil and gas stocks, even US oil and gas stocks, have not, as a group, responded to this huge spike in crude. What is driving that?
Well, I think in the lead up to this, the performance of these equities, energy equities, had been very strong, probably in the face of a bit of a weaker crude tape. And the prevailing narrative heading into 2026 was crude supply glut. We saw that sort of peaking in the first half, potentially the first quarter, and then the situation improving from there. I think that the stocks had started to recognize some of that. I think investors, to your point, are waiting to see the outcomes here before they fully price this into the back end. But our thesis had been that there had already been a bit of a re-rating of the terminal value of these businesses. There's an acknowledgement that the Canadian businesses, I used to use the phrase battle tested. I think we're going to probably walk back from that in light of current events here, and say that they've created anti-fragile business models. Most of these producers, create free cash flow, they've improved their break evens. The balance sheets are, for the most part, in tremendously strong shape. So these are businesses that generally work pretty well at lower commodity prices and very long duration assets. So over the course of time, you're going to capture these sorts of short-term upward movements in short-term cash flows, but the durability of it in a lower price structure still remains there. And I think trying to figure out what the terminal value, what the ultimate, we use a NAV or a discounted cash flow model, what the right price assumption, I think it's still going to take some time to suss that out here.
Yeah, so I'm hearing from you that investors on the buy side are sitting on their hands because there was such a run up that maybe it kind of priced in these higher crude prices. What do you think would be a meaningful catalyst to price in maybe a higher for longer oil environment? Is it something geopolitically? Because as you said, I read the analysis too. It's a lot of if this, then that. If that, then this.
Yeah.
No one's really willing to say this is how it's going to play out. And maybe it's because the U.S. administration itself doesn't know how it's going to play out.
Yeah, I think the U.S. administration, in terms of their policy goals, lower energy prices is clearly one of the goals. So they're going to, push policy in that direction where they have the ability to. I think the unknowns that we'll try and figure out, and this may take weeks, it may take months, but ultimately, what sort of damage has been done to call it, productive reservoirs? There's shut-ins. Will those have impacts on the reservoirs? What's happened to, damage to the actual egress systems, refineries in the Middle East, and how that impacts OPEC's spare capacity? And I think in the background of this, keep in mind, and we highlighted this in our report, one of the things that OPEC was going through here in 2026 and into 2027 was an actual audit of their spare capacity. And this throws a bit of a wrench into that process. In particular, with respect to Iran, their quota was going to be set based on their productive levels in 2026, and how that's impacted. Will they get some sort of waiver? So trying to figure out where, once things settle down from the conflict, where the actual OPEC spare capacity is. I think the second factor that we'll watch very closely is what ultimately happens with the regime in Iran. Do you end up with a government there that is more constructive to the Western world, and does that ultimately ease sanctions and create a pathway to higher levels of production for the country, or do you see a sort of doubling down and have a regime that remains antagonistic to Western interests, and sanctions remain in place? So,
It's
sort
looking
of
like
trying
the
to work through.
latter because it's looking like the latter. The new supreme leader is the son of the former Ayatollah, and his whole family was just killed by the U.S.
Yeah, these things change quick, right?
Yeah. I mean, a lot of this has shone a spotlight on Canada, which is also why I wanted to talk to you in particular about this, because it's shown up in a few different ways. One, Canadian oil prices have obviously responded, and you're now getting, $70 crude, which is a multi-year high. The discount on Canadian energy, Canadian oil prices has also narrowed.
Mhm.
You've got all these big macro factors. How do you see this? How do you drill this down to what this means for Canadian crude prices and what these producers are going to be able to capture?
Yeah, we've seen a tightening of Canadian landed heavy oil differentials if you can get barrels to the Gulf. I think there's a drive for security of supply. I think that there's some things going on in the crack markets as well that are driving that. Jet and middle distillates, diesel are certainly outperforming gasoline. And now if you have coking capacity that's spare in the Gulf, you want to fully utilize that. Not utilizing that, probably an analogy would be, buying a Ferrari and only driving it in a school zone. And so that's tightened up some of the Canadian heavy oil differentials in the short term. I think we need to take a bit of a longer term perspective. We still have the MOU going on in the background. We saw some of the
Just a
regulatory
memo of understanding between Alberta and the federal government around new infrastructure, potentially pipelines.
new infrastructure. And I would say that infrastructure in the immediate term, probably for the next several years, is not necessarily the biggest challenge. We do have some projects on the go here: TMX expansion, uh, Enbridge mainline, MLO phase 1, phase 2 potentially, where we can expand our egress. These things take time, they take capital, and they take coordination between various levels of government. And at least what we're seeing is an increased level of coordination. We had a bit of a chuckle yesterday. There was a news report that the Canadian government was looking to increase oil production with a sense of urgency, maybe delay maintenance. The time to facilitate higher oil production was 5 years ago, maybe more, in terms of the egress that we had in place. But certainly we're seeing a thawing of those relations. Now, one of the big pieces of the puzzle that will come in the near term will be the carbon pricing framework. We've seen Canadian Natural Resources, for example, they were very explicit in reducing some of their front-end engineering and design on a mine expansion capital that they would have spent in 2026. And the reason they did that was because they need regulatory and policy some level or higher degree of certainty about what that framework is going to look like. So that's a big piece of the puzzle that we're looking for in April here.
I mean, that's a good point. And for those who didn't know, so yeah, CNQ effectively shelved an $8 billion project because of regulatory uncertainty. I was actually going to ask you about those comments by the spokesperson for the energy minister that they are looking to urgently help with the global supply. I mean, you said that it's like 5 years too late. How practical is it now to even do something like that? Could energy from Canada, can production from Canada go any way to solve the potential deficit from these supply disruptions in Iran?
I mean, short term, there are a few things that we can do. We have some spot capacity in TMX.
This is the Trans Mountain Pipeline.
Trans Mountain Pipeline. Sorry, we use a lot of acronyms in this sector, so I'll have to keep that in mind. But
keeps me employed, Patrick. Half my job is just to be a translator.
So there is some spot capacity that can get taken up on that pipeline, and those volumes we think would predominantly go to Asia in the context of the current market and the competitiveness of landed Canadian heavy oil costs into those markets. If we needed to supply more in North America, we do have some rail capacity. It's mothballed today, and I don't think you can instantaneously utilize that. I think the Canadian government, one of the things they talked about is delaying the maintenance cycle. Typically, the maintenance cycle, a lot of it happens for the oil sands here in the spring, in the second quarter, late first quarter into the second quarter. But there are ramifications to that. If you delay it in the second quarter, at some point you have to play catch up on that.
Okay, Patrick, with all that said, I think a lot of people want to know who is best positioned right now, either to ride out the volatility or to benefit later on. Do you have a couple of high conviction ideas that you'd recommend to investors that maybe didn't run up kind of into it and that there's still room for upside?
Who did not participate in the rally? Well, I think that has been few and far between. I think a lot of maybe some of the smaller companies. I would say when we were looking at it, we had the performance for Cenovus this week, in light of everything that's happened, has actually been in our opinion, a little bit soft. It's a company where strategically they have the ability to move barrels on TMX. They have the ability to move barrels to the Gulf. One of the challenges that they have had is that as tight oil differentials have as heavy oil differentials have tightened historically, their refinery profitability has gone down. But we're actually seeing strength in the crack markets that could offset some of that. I had them in Texas about 2 weeks ago. This was prior to the conflict in Iran, and I thought the story looked pretty clean and pretty good at that point in time. So I would suggest that. You think of some of the things that are happening in the crack markets, and that puts Suncor and Imperial in a pretty good position. Suncor, I would point to just because they have. If you think about the three integrated producers, when we track them, they typically have the highest middle distillate yield from their refineries. So that's going to work pretty well in the short term here. They do have a major investor day coming up on March 31st. We think the next leg to the story here is going to be what they do in sort of 3 to 5 years in terms of backfilling base mine. I think it's no secret out there that the reserve life at their base mine asset is fairly short. But some of the work that we've done on the performance they've had, in particular from some of their enhanced solvent production at their Firebag asset, has put us in a pretty positive position in terms of what the capital efficiencies of backfilling that could look like relative to what the market is expecting. So that would be one. And then, your crude oil exposure, a couple of names that I would think about here. Athabasca, again, multi-decade reserve life, going through a near-term growth program here. They're expanding their Leesmere asset. Following that, assuming that we have, a solid policy framework, they're going to move forward with their Corner asset. That's one of the best greenfield assets out there in the oil sands. And so you have a company today that's producing probably 36,000 barrels a day of thermal production that by the time you get to 2030 is going to be producing about 65. And so, a tremendous amount of growth out there. And you think about, even if they hold the multiple they're at today flat, where that could go to towards the end of the decade. Very clean capital structure there. Balance sheet has net cash and a focus on returning any excess capital, any excess cash flow to shareholders. Very focused on the NCIB. So that's a good one. Another one, and they'll report after market today, is Strathcona. Again, this is one of the companies that has, one of the higher sort of sensitivities to the oil price here. So at $58 crude, probably just covering the dividend obligation, and at $80 crude, there's close to $1 billion of free cash flow in the business.
All right, great perspective. Thank you so much for joining us, Patrick O'Rourke, for what the tensions mean in Canada. I appreciate your time.
Thanks.
Make sure you tune in to our next episode. It's going to be a little bit of a different flavor. We've got the head of Canada's banking regulator, OSFI. Peter Rutledge will be my guest. And if you'd believe it, the regulator, his job is to be worried about a lot of things. He is, dare I say, optimistic. Find out why in the next episode.